In today's video, we'll explore how to improve your trading skills, the best strategies for performing well in the stock market, and the essential principles and tools for backtesting trading strategies. Whether you're a seasoned trader or just starting, this video will provide valuable insights to enhance your trading journey. Before we dive, please remember, this is not a financial advice. Please do your own research before investing. Let's dive in. The first step to improving your trading skills is education. Read books and articles on trading strategies, market psychology, and technical analysis. Some classics include A Random Walk Down Wall Street by Burton Malkiel and Market Wizards by Jack D. Schwager. Practice makes perfect. Use paper trading accounts or demo accounts to practice without risking real money. Tools like TradingView or Thinkorswim offer simulation environments to test your skills. Develop a clear trading plan. Set specific goals, determine your risk tolerance, and establish a consistent strategy. Use risk management techniques such as stop-loss orders to minimize potential losses. Keep a trading journal to record every trade, including the rationale, entry and exit points, and outcomes. Regularly review your journal to identify patterns and learn from your mistakes. Enhance your technical analysis skills by learning to read charts and use indicators. Improve your fundamental analysis skills by analyzing financial statements and understanding economic indicators. Control your emotions and stay disciplined. Avoid overtrading and making impulsive decisions based on emotions. Be patient and wait for the right opportunities. Join trading forums and engage with other traders to exchange ideas. Follow experienced traders to learn from their insights and strategies. The market is always evolving, so stay adaptable and keep learning. Regularly update your strategies based on new information and market conditions. Attend seminars and workshops to further your knowledge. One of the best strategies for the stock market is long-term investing. Buy and hold stocks for extended periods to benefit from long-term growth. Use dollar-cost averaging to reduce the impact of market volatility. Value investing involves finding undervalued stocks based on intrinsic value. Use fundamental analysis to identify these stocks and invest with a margin of safety to reduce risk. Focus on high-growth companies with strong revenue and earnings potential. Look for industries expected to grow significantly, such as technology and healthcare. Invest in companies that pay regular dividends for a steady income stream. Look for companies with a history of consistently increasing their dividends. Invest in index funds or ETFs that track major market indices. This provides broad market exposure and reduces risk. Index funds often have lower fees, enhancing long-term returns. Rotate investments among different sectors based on economic cycles. Invest in defensive sectors during downturns and cyclical sectors during expansions. Use technical analysis to predict future price movements. Study chart patterns and use indicators like moving averages and RSI to identify trends. Invest in stocks with strong performance momentum, expecting them to continue performing well. Set strict rules for cutting losses to avoid significant downturns. Contrarian investing involves buying stocks that are out of favor and selling popular stocks. This strategy requires thorough research and strong conviction. Manage risk through diversification, stop-loss orders, and proper position sizing. Evaluate performance regularly and adjust strategies as needed. Stay informed about market news and economic indicators. Continuously evaluate your performance and learn from successes and mistakes. Backtesting is the process of testing a trading strategy on historical data to evaluate its performance. By simulating trades over past data, traders can gain insights into how their strategy might perform in real market conditions. Ensure data accuracy and use the appropriate granularity. Divide data into in-sample and out-of-sample sets to avoid overfitting. Keep strategies simple and robust. Include realistic transaction costs in your backtests. Use risk measures and position sizing rules. Perform walk-forward analysis by re-optimizing your model on a rolling window basis. Make realistic assumptions about order execution and market impact. Stress test your strategy under different hypothetical scenarios to see how it performs under extreme conditions. There are many tools available for backtesting trading strategies. Some of the best include Quant Connect, MetaTrader 4/5, TradingView, AmiBroker, NinjaTrader, Backtrader Zipline, and even Excel for simpler tests. By following these principles and using the right tools, you can effectively backtest your trading strategies and increase your chances of success in live trading. We hope you found this video helpful. This video is for informational and educational purposes only. Thanks for watching.